Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps Morning Meeting. My name is Mark Tobin. I'm the founder of Coffee Microcaps for anybody who is joining us for the first time, and indeed for anybody who is one of our regular attendees. Welcome back to this morning's event. It's great to have you back on. I'm just going to quickly run through these intro slides, and then we're going to get straight into it with our first presenter. A quick mention of our sponsors, DMX Asset Management. If you are looking for a small or microcap focused fund manager, please do check out the DMX website for all the relevant documents and application forms, or indeed get in touch with Stephen or Michael. Their email addresses are there. Quick compliance and disclaimer slide. For anybody who is joining us for the first time this morning, the companies we normally have presenting on here are capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources or biotech sectors, what I like to call industrial microcaps, which kind of covers the various other industry sectors outside of resources and biotech. Structure this morning's webinar, we've got 3 companies presenting. It's actually going to be an hour and a half this morning. Each company's got a 30-minute slot, which we roughly break down into a 20-minute presentation and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and it will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials. Twitter is probably our main one. YouTube, as I said, for the recording of this webinar, and indeed all our previous ones. There's well over 100 company presentations on there now at this stage. LinkedIn, and I also write a free monthly newsletter that you can get on the Substack platform. First up, we're going to have Peter McGrath, CEO of Comms Group. Following that, we are going to have Grange, the CEO of Maggie Beer, and then rounding out this morning we'll have Bradley McCosker, CEO of Australian Bond Exchange. So without further ado, I'm going to stop sharing my screen and hand you over to Peter. Peter, if you want to start sharing your screen, I'll let you know when I can see it coming through. Yeah, I can see the cover slide of your presentation now, Peter.
Okay, great. Can you hear me there, Mark?
Yeah, your audio sounds good, so you can take it away.
All right, thank you very much. Thank you, Mark, and thank you to all those attending here today. We've got some exciting news to announce from some recent announcements we've put out to the stock exchange. I'm going to run through those this morning, as well as give an update on market guidance and strategic review. I'll cover these sections today, and I believe we're taking Q&A at the end. In terms of an introduction to Comms Group, we're a global telco service provider, and we also provide IT services. We're headquartered in Sydney. We were established in 2008 and listed on the Australian Stock Exchange in 2017. And we provide services to businesses. So predominantly we're a B2B provider, if you like. That includes enterprise, government, and also wholesale to international telcos. And we have 3 key divisions. Our global business, Comms Group Global, which is a global voice specialist, the latest technology, unified communications, and in particular, Microsoft Teams calling to multiple countries. I'll expand on that throughout this presentation. We also have a domestic telco, a leading provider in the mid-market in Australia. They're branded as Next Telecom. We've acquired a number of businesses over the years, which we've brought into that division. They have an extensive product set, an offering. They sell direct and indirect via a channel partner network, and they also have a great level of customer service being based out of Australia. Then finally, onPlatinum ICT, our domestic Australian specialist IT service provider, headquartered out of Queensland, but with a national coverage. Our catch line is that we enhance business agility through innovative cloud-based communications and IT solutions. So we're a cloud services provider in that many of our services are based in the cloud, including voice services. They've all moved to the cloud nowadays as well. You can see here a little bit more detail on our three divisions, with Next Telecom focusing on the SME and the corporate mid-market. We cover also government, local government. We're a national provider, but a particular expertise in Queensland, New South Wales and Victoria, and an award-winning telco. I mentioned before that we have our service team based in Australia. We pride ourselves on that level of service. Customers ring up, we answer the call straight away, and we also deliver, the latest generation products and services. I'll just move across to onPlatinum, an award-winning IT managed service provider, targeting also the corporate mid-market. So these are organisations typically with 1,000 employees and a full range of IT services with high levels of customer service as well. And then our global business, which provides unified communications. I'm going to expand on that for those listening today who don't understand what we mean by UcaaS with the next couple of slides. We're located across Sydney, Melbourne, Gold Coast, Singapore, Philippines, and the UK. And there's a reference there to our website if you'd like more information. We often get asked the question, well, what are the products that you sell? Because the technology and telco sector is quite broad. You can see here, this is really for your reference. I'm not going to go through the detail here, but you can see here that we have a number of key product areas that we provide services to our customers. The first two towers there is really what Next Telecom does. Specialised services for businesses. We're one of the major providers of fibre optic-based internet services in the market. We don't run our own network there, but we still provide extensive services to our customers. The middle tower there is onPlatinum. You can see the extent of the services that they provide. So if you're a mid-market corporate, you don't want to invest in a large IT services team, but you still want the latest products and services, and particularly in the cybersecurity area, you would typically go to an onPlatinum and outsource your IT managed services. On the right-hand side there, you can see our global business, or some of the products that we offer there. In the unified communications area, a lot of the large enterprises around the world are wanting their staff and their business to use the latest unified communication services, and Microsoft Teams is the leading product in that area today, and in particular, the Microsoft Teams calling product is how we connect those enterprises to the public switch telephone network. That way, their customers, their suppliers can communicate directly with them via Microsoft Teams. And then some of the more specialised wholesale and global products are listed there. And we're a key provider of wholesale voice services, particularly across the Asia-Pacific marketplace. We have a list of definitions at the back of the document if some of these words you do not understand. But things like telephone numbers, if you're a global enterprise, or you're an IT services provider, or you're an over-the-top provider, such as some of the big application providers, you'll need telephone numbers in various countries around the world. You'll need SIP trunks, and you'll need to be able to terminate calls in those various countries, and that's the type of services we provide. We have a global voice network, and you can see here from these purple dots, these are what we call our super pops. We have 6 super pops. They're located in the US, East and West, London, in Germany there, down into Singapore and into Australia. And then we have a number of what we call minor pops, points of presence, particularly through the Asia-Pacific region, where we need to put infrastructure on the ground in various countries due to their regulatory rules. And then we currently going through an expansion phase into South America and South Africa. This is the latest generation voice network. It's all digital. We typically run these in public cloud infrastructure. One of the leading providers in the world. These are very high capacity. Each one of these nodes can handle 40,000 simultaneous calls. And we use these to provide services both direct and indirect via our wholesale business for those organisations that want to run a global unified communications type service. We can connect customers in circa 60 to 80 countries. So although these points of presence, for instance, in Singapore, we have that super POP that actually connects into a range of countries throughout that area. Similarly to Europe, we connect and provide services throughout most of Europe, but we use those two super POPs as the key aggregation points. We want to move now to a business update and just talk about how the business has performed over the last 12 months or so. I'm really happy to say that we've had a continued strong level of new sales within the business, which is really exciting to see. Our total level of new sales for the 9 months to the end of March is 7.2 million in what we call annual recurring revenue. We typically measure that on a monthly or quarterly basis, but then convert that to what is an annual figure. We tend to target recurring revenues. Probably 90+% of our revenues are recurring. We'll sign multi-year contracts, typically 3 years, sometimes more, and we bring the customer on, and therefore we target that annual recurring or that monthly recurring revenue. We do also get one-offs, that's important as well, but primarily we want to set the business up to have that growing recurring revenue. In the global business, we're finding the sales cycle for some larger deals is proving quite long, 6+ months, but these are significant and large deals. And we have a very high quality pipeline that's been building there. For 23, we expect for FY23, so that's to June end this year, we expect our overall revenue to exceed 51 million. We have acquired a number of businesses over the years. We've been very careful with acquisitions. We haven't gone out and just acquired whatever business we see. We've knocked back more businesses than we have acquired. We typically look for businesses that are generating a good level of EBITDA and that they have strong management that want to come on board and be committed to the business. And obviously, we look for businesses that are generating typically a high gross margin. So we've acquired a number of businesses over the years, and we've had a specific target to extract synergies from those businesses. And I'm happy to say that over the last 2 years, we've delivered the majority of the synergies that we set out to deliver. We also acquired our ICT business probably now 18 months ago, and about 40% of the expected 300K has been delivered in synergies from that business. We'd expect to get to 50% by 30 June, and with some other key synergies coming on quickly in the first part of FY24 and the remainder in FY24. So the delay with some of those synergies coming on board is it resulted in lower margins in that ICT business in FY23, but we're still confident we can deliver the rest of these synergies. A recent trend that's emerged is we're seeing a good level of cross-sell between our IT services business onPlatinum and also our domestic telco, Next Telecom. This has been a specific strategy. We have 4 key product areas that we're targeting, from relatively simple, such as security, cybersecurity audits, right through to a full portfolio of managed IT services, and we have a number of live opportunities. So we have a team working on that, and we believe that that's a really exciting emerging opportunity for the business. We announced a restructure back on the 4th of April. That's been completed, and it's resulted in a reduction in OPEX costs of circa 2 million, and that's predominantly in our domestic SME and domestic ICT businesses. Post that restructure, the businesses are performing well, We're still seeing a very high level of sales performance and excellent levels of customer service. We have been asked recently by some shareholders and investors, what is happening in the external marketplace with costs. So we wanted to answer that one specifically. Gross margins in our business are continuing to hold up at similar levels to recent historical levels. And we have not seen any major key supplier cost increases that are impacting the business. So we're probably fortunate in a way that we're in a sector where a lot of those cost imports are either fixed, such as NBN type costs, or we're getting a healthy level of supplier competition. But at this stage, we're not seeing any major cost changes. In terms of business unit performance, obviously we're not at the full end of year yet, but we're close to it. We expect our run rate EBITDA for our SME business by year end to be around about 4.5 to 5 million. And that's subject to us bringing on board some recent sales contracts and also some further synergies. In our ICT business, we'd expect the run rate EBITDA to be circa 2 to 2.5 million. That is dependent upon some high levels of sales signed, particularly in the March quarter, coming on board, and also some synergies being delivered. Our global business, the EBITDA is lower there, around about the 1 million. We are continuing to invest in that business, particularly with staff in various parts of the world, as we position that business for what we're seeing is significant growth opportunities moving forward. Separate from those particular divisional or business unit guidance, we do have head office costs of circa $2 million. In terms of the recent Vodafone announcement, this was announced just recently. We signed a further agreement with Vodafone via Vodafone Group PLC. We're dealing with the global Vodafone Business Group. This is a new contract to deliver a service called Microsoft Operator Connect. I'm going to cover that very quickly, but there's a lot of more information online about that. This is a really exciting initiative. We spent 9 months working on this. We're also delivering to Vodafone globally advanced automation and self-service and provisioning tools, and a state-of-the-art platform so they can manage their customers. From a Vodafone perspective, they'll be able to see all of their various operating companies around the world via this platform, and obviously be able to bring customers on very quickly. The service is for Microsoft Teams calling, but in the enterprise market, that is probably the largest growing unified communications platform in the world. The term is for 5 years, and after which it will be extended on a month-by-month basis. We've pretty well delivered the services that we said we would deliver as part of the contract. They'll be ready at the end of this month, and then initially we'll be providing these services for the enterprise team UK, Vodafone UK and Germany, and then we'd expect other operating entities to come on board. We are charging a minimum monthly charge of 30K per month for this new service. We're already seeing circa 20 to 30 in revenue from Vodafone, and that's growing at circa 10% per month. And we also have a significant pipeline of opportunities with Vodafone. So Vodafone is a key partner for us. We have a very good relationship with Vodafone. This is Vodafone globally. It's not domestically in Australia, it's globally, around the world. We deal with their business units in US, Europe, obviously the UK, Asia Pacific in particular, out of Singapore. And we have a really positive working relationship with them. We're providing their core Microsoft Teams calling services globally. Operator Connect, very quickly, it's a comprehensive customer experience platform with network and technology standards, and it allows large enterprises and smaller businesses, if you like, to go in and choose their telco carrier off the Microsoft Operator Connect portal or the marketplace. They can click into that and determine, for instance, in Indonesia, who are the providers, click that, select their numbers, etc., etc. So it's a very advanced platform. It also comes with a certain level of certification from Microsoft that you are a quality provider. And this is for choosing and connecting to the PSTN for Microsoft Teams calling. The market opportunity for Teams calling is quite large. You can see here that there's about nearly 300 million Teams monthly users today. And around about 12 million of those have connections to the PSTN. 80 million Microsoft Teams users daily use the service to talk to their colleagues, but they're not using the PSTN or the Teams phone license. We expect quite a lot of them to move to that over the time. There's a bit of a comparison between Teams Direct Routing and Operator Connect. This is more so for those who investigate and look at this in detail. But Comms Group is taking Vodafone to the Operator Connect platform via our wholesale services. We also provide Teams Direct Routing for them. We also do this for other customers as well. Strategic review and guidance. So just move to that quickly. I'm just mindful of the time. So we made an announcement to the market yesterday that the board's of the view that the current market valuation does not reflect the strong profitability and market position of the SME and ICT businesses or the inherent value and market position of the global business. And it's the board's view that the sum of the parts is worth more than the market's current valuation of the company. So the strategic review, which we've kicked off, will consider all options available, including a potential sale of one or more of the businesses in order to maximise shareholder value. And we've retained Latimer Partners as financial advisors to assist in the review. There is a separate announcement that's been put out to the market on that. In terms of guidance for this year, obviously we're very close to the end of the year, but it does take time to finish your results and do your audit. So these are subject to audit. But we expect our revenue to exceed 51 million. Gross margin very high across the business, circa 47% for gross margin and around 24 million in gross profit. Underlying EBITDA expected to be in the range of 4.8 to 5 million. And for FY24, following that recent restructure, we're giving preliminary guidance of underlying EBITDA of 7 million for the year. And that's for FY24. That's all I want to cover at this stage, and I think I'll hand back to you, Mark.
Perfect. Thanks, Peter. I might just quick off the questions here. People a bit gun shy this morning. The first one is, if we look at the Next business, you know, that kind of move from the legacy PBX systems to, you know, a Viper or cloud-based system. I mean, that's been going on for I guess many years now, but you know, how far is the broader market actually adopted these cloud services? You know, how much kind of business do you think is still there in terms of doing those conversions and running those services for the kind of SME market in Australia?
Yep. So domestically in Australia, there's been a move from the old analog services provided firstly by the carriers, and then, you know, we had PABXs within offices, to putting that into the cloud, whether that's a hosted PBX or more recently these cloud, what we call cloud phone services. So that has been happening probably for 15 years. The big move off the PSTN, the copper-based PSTN, is really only been pushed ahead from the NBN. But today, you know, the majority of voice services, I'm not including mobile, but the majority of voice services would be IP-based. What's the more recent trend in the enterprise end of the market, the large corporates and even coming down into the mid-market now, is to move from hosted PBX, generic from, you know, various different telco carriers, to, you know, branded global platforms from the likes of Microsoft, Cisco, 8x8, RingCentral, and a few others like that. Zoom's in there with Zoom Phone. That is a big trend that's occurring now. And so we call that unified communications. And the leading provider in the Gartner, if you go to the Gartner research, to the leaders quadrant is Microsoft. Cisco is very big as well. but Microsoft is leading the push, and that's a more recent trend. What we're seeing now, though, is we're getting mid-market customers and smaller businesses are now saying they want Microsoft Teams calling. And that's a more recent trend, probably over the last 12 months. And we're seeing that that is starting to gain a lot of momentum. So there is a move to the latest generation products underway right now.
Okay, so yeah, it's more the next evolution, I guess, in comms rather than just the pure conversion from, you know, analog to digital and putting everything in the cloud or, you know, on VoIP. It's kind of we're into the next evolution of how companies are dealing with comms, basically.
We are, yeah. So I think when the move to hosted PBX occurred, so there was no PABX in your office anymore, it went to a server run by the local telco. The problem with that was, although it was a step forward, it didn't give mobility. And when you weren't in the office, in most cases, you still couldn't handle your work communications. You know, you couldn't receive your calls, you couldn't make calls from your work number. Now that it's moved to cloud phone, you also get an app on your phone. And in fact, most of the physical handsets are now disappearing. And so being mobile, working from home, traveling overseas, traveling interstate, and still being able to make calls and receive calls for your work, your work service is now part of the norm. It's now expected, and it really followed COVID. And, you know, a lot of our services are in that space. We are a leader in Microsoft Teams calling across the region, and we connect large multinationals who want, say, 20, 30, 40, 50 sites around the world with that capability I just outlined. And that's the big trend that's occurring now around the world.
Okay. I just want to quickly mention, people will be familiar with RAS Group, and Comms Group is indeed covered by RAS Group, and I've uploaded into the chat their latest note that was out this morning, which covers the Vodafone deal and indeed the strategic review. So if anybody wants to download it, it's in the chat. But Peter, just another question, you when we mentioned the Vodafone deal, and just and I know you mentioned you haven't seen really any major cost inflation coming through, but on the sales side, how are you working? You know, because most of your contracts are 3 years in length. How are you working, you know, this kind of higher inflationary environment we've been in for the last 12 or 18 months in terms of, you know, contracts you're signing now that are going to run out for 3 years, or, you know, renewals with existing customers that have kind of come up in the last 12 months and, you know, putting in, you know, either price increases or how you're structuring? Is it, you know, still a CPI place increase on top of the new?
Yeah, so yeah, Mark, that's a very good question. So it depends on the area, of course, across our business, but in our domestic telco and our IT services business, we have pushed through some cost increases or price increases. We typically have CPI price clauses as well, and also suppliers are pushing through cost increases. So in our IT services businesses, we have had some cost increases come through, and we've been able to pass those on because they're for some kind of generic products. I won't mention the vendors' names, but they're products that everyone has to use. And so some of the big global suppliers have increased their prices there, and we have the ability to pass that charge through. So we've been doing that. But, you know, some of the other core telephony products, particularly in the voice area, we haven't really seen any price increases there or cost increases. But, you know, we're mindful at the right time of increasing prices where it makes sense.
Peter, we're literally just up on time now, so I think we'll leave it there rather than trying to squeeze in one last question. Thank you very much for joining us this morning. And if I could just please ask you to stop sharing your screen.
All right, thank you very much, Mark.
Thank you. And I do know we have Grange standing by, who is the new CEO of Maggie Beer. Kinda, if you want to start sharing your screen, please, I'll let you know when it starts coming through. Yeah, I can see the cover slide of your presentation now, Kinda. You can take it away whenever you're ready.
Great, thank you, Mark. Good morning, everyone. Thanks for joining today. So I'm the newly appointed CEO for Maggie B Holdings. I joined the business at the beginning of March, and I'm really pleased to be here today to share with you my observations of the business 100 days into the role, how I'm thinking about the future of the business in terms of our aspirations, our vision, and our strategy, the enablers to unlock that, a brief summary, and then we can open the floor to a Q&A. So when I joined the business, I got asked a lot, why did I decide to join the Maggie B Holdings business? And, I was really attracted first and foremost to the potential that I could see in the business. Obviously, the iconic Maggie B brand and being someone who's had a 20-year career in food, that really appealed to me. I could see that we had, really strong manufacturing assets, and I was really attracted to the diversity of channels through an e-commerce platform. And then in addition to that, I could see that the business had a really strong balance sheet. So after 100 days, I'm really pleased to say that all of those assumptions coming into a new role have just been reaffirmed. And I would summarize my view of the business today as one that has really strong assets with untapped potential. And that's really strong assets in brands, not just Maggie Beer, but also the Hamper Emporium, which is our hamper and gifting business, and Gifts Australia, which is a very valuable domain name. We also have really strong manufacturing assets. They are scalable, they are fit for purpose, and they include an innovation hub in the Barossa and a test kitchen for Maggie Beer products. We have strong capability in our hero products of paste and pate under Maggie Beer, and we have a high quality dairy manufacturing asset. And we have a really strong e-commerce business, and in particular, a really strong e-commerce backend with global procurement capabilities, a scalable and efficient fulfillment centre, and efficient dispatch for timely delivery. And all of those assets are underpinned by a really passionate and nimble team. Over the past few months, I've really enjoyed meeting and spending time with our people at our sites, with our customers, and with our investors and out in stores. And we have a really strong balance sheet, as I've already said. So with all of that in mind, as I was shaping the strategy for the future, I could see that we have, all of the ingredients that we need in the business today. And so as I look at the future, we've articulated a vision, which is to champion the joy of Australian food and culture and gifting. And when you think about the occasions that our business is in terms of sharing food, sharing entertaining platters, receiving a gift or giving a gift, all of those moments spark joy. And that's a really, really great place to be in and offers a lot of scope for the business to continue to expand. And we have a really bold aspiration, which is to create a $300 million net sales revenue business, and one that has strong margins and return on assets. And the reason I think that that's achievable is because when you look at the addressable market that we operate in, across those pillars of food and culture and gifting, you can see that food is an $8.3 billion opportunity, culture, which I'm defining as kitchen, home and garden, and I'll talk about that in a second, is almost $6 billion online, and gifting is a $22.5 billion business. So our in-scope market opportunity over the next 5 years represents, quite a significant one. But to achieve that aspiration has required us to think differently about the business and to reimagine those assets that I talked about, to reimagine Maggie Beer from an iconic food brand to an iconic food and lifestyle brand, and one that's available in kitchens and homes and gardens all around Australia. For Paris Creek Farms, to reimagine it from a specialist organic dairy that's really focused and being built around white milk, to a superior quality dairy manufacturing asset with strong capability in the value-added dairy segments like cheese and yogurt and desserts. And to reimagine Hamper and Gifts Australia from a market-leading hamper and gifting business to a market-leading e-commerce platform that is the first choice destination for gifting, entertaining, and sharing occasions. But probably more than reimagining, these individual assets, it's actually about reimagining what they can be together as a unified force. And so I'm articulating our growth strategy around these three key pillars to realise the untapped potential of our business. Firstly, it's to optimise and unify our assets. We made the decision last week and announced it to the market that we will be retaining the Paris Creek Farms asset, and we will be investing in its capacity and capability, and I'll talk about that a little bit more. We are looking at the opportunities to integrate the three discrete business units and unlock synergies as well as cost efficiencies, and to streamline our operations, implementing really strong S&OP processes right across the businesses and continually looking for ways to continue to make our core range really efficient. And so that first pillar is really about, optimize, unify, and deliver efficiencies and continue to strengthen the foundations that we have in place. The second pillar is about expanding the Maggie brand. And that's firstly about growing our core business by increasing our penetration in our current channel footprint of retail and online, and in particular, focusing on the Eastern Seaboard as an area of opportunity and some supermarket accounts as well. The second pillar is about expanding the brand across food and lifestyle by leveraging our e-commerce capability. And the third pillar is, really unlocking the potential of the Maggie brand, which is so well known by everyone in Australia. And it's about actually creating the awareness of the products and the offers that we have both in supermarkets and online, and changing our approach to marketing so that we take an omni-channel approach and a really integrated approach to building that brand. And then the third pillar is scaling our e-commerce platform. And that starts with continuing to strengthen our foundations in operations, getting an absolute, obsession with customer service, improving our conversion by enhancing the customer experience. And I'll talk about that a little bit more. And then obviously, the offer, the product offer and the solutions are really important. So we will keep those fresh, but I'm also really excited to build out new verticals and growth horizons for that business as well. So I'll now touch on each of these three pillars. So firstly, optimizing and unifying our assets. And I'll just talk to the rationale for deciding to keep the Paris Creek Farms asset. So I guess there's two things that, we look at in assessing opportunities. One is attractiveness, and then the other one is our ability to win. So from an attractiveness perspective, and, particularly for me coming in new to the business, when I looked at the dairy categories in terms of their size and scale, the growth and the trends in those categories, I was really excited to see the value of those dairy categories. And interestingly, there's some of the categories in the supermarket where shoppers are willing to pay more for a premium product. And then from an ability to win perspective, we've actually demonstrated with the Maggie brand a proven success in cheese. So our specialty cheese range in supermarkets, is the largest category for the Maggie brand. And is continuing to grow and expand. And then secondly, from an e-commerce perspective, we launched cheese hampers in the Hamper Emporium site about a year ago. And already, those products are delivering almost $3 million in revenue, and there's a lot of upside there. So given, the attractiveness of those categories, given the fact that we see an opportunity for Maggie to continue to play in and expand in dairy, we have retained that asset and we are focusing on two key things. The first one is optimizing the asset for efficiency. And that's about looking at reducing our costs, taking a continuous improvement mindset, optimizing our core range. And, there are areas where we have a long tail, and continuing to sweat the asset, focusing on growing volume in cheese, yogurt, butter, and milk. And the second pillar here is to enhance our innovation in existing capability, but also we've made a decision to invest in white mold cheese capability and capacity, to automate that part of the plant and to build capacity, which allows us to bring the manufacturing of Maggie B cheeses in-house. They are currently outsourced, and that'll really allow us to grow the Maggie B cheese range in supermarkets and also expand our hamper offering. From a yogurt perspective, there are further opportunities for us to leverage the existing capability in yogurt. We make fantastic quality, super creamy Greek style and European style pot set yogurts, and we see opportunities to expand that. And we will continue over the next 5 years to develop other high value dairy innovation under the Maggie B brand. And we will retain the Paris Creek Farms organic offer of products. Moving on to the second pillar, which is expanding the Maggie B brand. We're looking here for an aspiration to grow the brand to 125 million over the next 5 years. And we're focusing on 2 pillars, good food and good life. So good food is all about really narrowing in on the occasions of cooking and entertaining and desserts. And you can see that those spaces offer a significant TAM opportunity. And in terms of good life, some of you may have seen that we recently launched the Maggie Living range with some kitchen essentials. We'll be expanding that beyond the kitchen into ranges for the home and the garden. And all of these ranges will all be built, on the basis of the Maggie B ethos and on the basis of the products that, Maggie herself, can't live without. And all of that, expansion of the brand will be underpinned by investment in master brand advertising. So consolidating our advertising spend into fewer, bigger, better initiatives that can reach more consumers. We will continue with an always on media strategy, particularly leveraging our owned media, which is our digital channels like Instagram and Facebook. And we also have a food club, with a really loyal following, and we want to continue to reward our loyalists and expand that community, of Maggie B brand lovers. So just looking at good food, good food is really focused more on the supermarket channel, with some presence online through recipes and bundles and gifts. And we will continue to focus on our core products like stocks and broths and finishing sauces, cheeses, paste, pâtés, and non-alcoholic beverages and ice cream, which is quite iconic for the Maggie B brand. And then in FY24, we'll expand our pasta sauces and sugos. We will bring manufacturing for cheese in-house, and we'll expand ice cream. But in addition to that, you can see that in FY24 and FY25, we have some new category entries. So these will be entries into, large categories where we think we have a real opportunity, to bring a Maggie B uniqueness and, attract a customer, and grow category value. And, as I'm sure you can appreciate, given the competitiveness of that landscape, at this stage, I can't share more details around those exact category opportunities, and I'll be able to do so closer to the time. In terms of good life, as I said, 3 pillars here are kitchen, home, garden. And you can see that in FY24, we have significant plans to expand the essentials kitchen range into baking and cooking products, in the home, table settings and entertaining, and then starting the garden entry point with Maggie B's garden essentials. And they will be available online, on our on our online e-commerce channels, as well as exclusively in retail, and currently we're in David Jones. And now moving on to the third pillar, which is scaling our e-commerce platform. So the three key focus areas for e-commerce is firstly, strengthening the foundations, and that theme here of delivering operational excellence end to end. We have really great assets in procurement, warehousing, fulfillment, distribution center, and we want to continue to make that as efficient as possible. To focus on great customer service at every touch point, continuing to build on our strong Net Promoter Score, and then increasing brand awareness. And at the moment, we've been quite focused, and have had success by being focused on online advertising to promote our three e-commerce channels. And in FY24, we're going to be trialling non-digital channels, so above the line channels, to create awareness of our e-commerce brands. And, I've seen other brands have real success, when they go down that path, and we'll test and learn, and, really bed that down for FY25. The second pillar is continuing to improve the conversion on our core business. So, we will be refreshing our websites, and we will be taking a mobile first approach because we recognize that that's an opportunity to improve the customer experience. We will also continue to expand our digital capabilities. We have a really large database of customers, across Hamper Emporium, Gifts Australia, and Maggie products. And, we will get more sophisticated in terms of how we segment and target those customers, and really understand those customer journeys even better. We also see an opportunity to reset our approach in corporate sales and B2B, as well as, B2B to C, which is actually, when you look at our business in Hamper and Gifts Australia, it's very much skewed towards Christmas. And so the opportunity to fully realise the potential of that asset is to grow our sales outside of just the Christmas period. And so corporate sales and B2B is one of the opportunities for us to do that. And then finally, keeping the range fresh, is really key. We generally do that at all of the key events, throughout the year, like Mother's Day, Father's Day, Christmas. We launch new products and new seasonal campaigns. So we'll continue to do that. And we have our, next big event coming up for Father's Day. And over the course of FY24, we'll also be trialling one new vertical for the business, and one new partnership as well. And that'll enable us to get those up and running in full force for FY25. And, again, those two are commercially sensitive at this point. So it's a big, bold plan, and we recognise that there are some key enablers to making that happen. The first of which, which will be of no surprise, is, people and capability. It's always about the people, and it's about owner's mindset. That's something I'm really passionate about. And, that's really about understanding the business and the drivers of the business, but also spending each dollar like it's your own. And that's something that's a part of the culture that I'm continuing to encourage in the business. Innovation, data and analytics are two key areas, where we will be building capability to deliver, the plan that you've seen, where innovation, data and analytics are really quite key. In terms of brand and marketing, I've talked about, a slightly different approach to brand building by taking more of a master brand approach, ensuring that our content is always fresh, but also utilising all of the amazing content that we already have, and, investing in advertising production, down the track when we need it. Being a large e-commerce business, we also need to continue to, to look at our digital ecosystem, ensuring that we're offering exceptional customer service. We will be refreshing our 3 websites, and over time we'll continue to refine our tech stack to ensure that it enables our strategy. And so, in summary, hopefully what you've seen and heard is, a real passion for the strong assets that we have in the business and the untapped potential in our market-leading brands, in our scalable and fit-for-purpose manufacturing assets, and in our strong e-commerce backend. And with that in mind, we've set a really, big vision and aspiration for the business to really champion joy and to create a $300 million business that has strong margins and return on assets. And we're going to do that by reimagining the assets in our business and reimagining growth, not just in our individual assets, but what they can be as a unified force. And we're really focused on the 3 pillars to firstly optimize and unify our assets. Second pillar, expanding the Maggie brand across good food and good life, and scaling our e-commerce platform to fully realize its potential. And so that concludes the presentation, from me. Mark, I'll hand over to you, and please note, if you've got any other questions or you want to reach out to me, you can see that there's an email address at the bottom of the screen as well.
Thanks, Kinder. I might just kick off with the first question. As you say, it's a pretty big, bold and strategy. In terms of CapEx over the next, let's say, 12 to 24 months, whether that be at the Paris Creek bringing the cheese in-house, or stuff you're going to do on the e-commerce side, and general closer integration of the kind of 3 main business units together. Have you got an idea of what it's gonna or the investment that needs to be made to to kind of realize the strategy you've set out there?
Yes, absolutely. So the main CapEx investment will be in Paris Creek Farms, in the cheese asset. So that's in the order of $4.5 to $5 million. And as I said earlier, that will really unlock not just capability and automation, but also capacity to allow us to bring the existing Maggie cheese business in-house, and give us, some really good headroom to continue to grow that business. In terms of other investments, it's really about, consolidating existing investments and spending the money differently. Reprioritize, one of the things I alluded to was advertising. So, reprioritizing how we currently, spend some of our media dollars, which is arguably more proliferated, and bringing that together and spending it across the master brand. And the beauty of really looking at these 3 parts of the business as, as one unified force, allows us to tap into and integrate and, drive some of those efficiencies as well. So, as I said, the CapEx, the main CapEx and the main incremental spend is really around that cheese asset.
And then just on the extension of the Maggie beer brand into that home and garden lifestyle vertical, how would the margins compare from the product sales in that versus the margins that you get from the food business or the food part of the brand currently?
So at a holistic level, generally the margins in the e-commerce business and direct to consumer are higher than margins selling into retail, and so that will be maintained with the Maggie Living range as well.
Okay, great. And then if we look out on, into that 300 million that you sketch out that you're looking at over the next 5 years, how would you see that kind of broken down between, if we take the hampers and gifts business on one side, and the Maggie beer brand business, whether that's through the retailers or through your own e-commerce platform, what would be kind of the split there, or how do you envision the two businesses evolving?
Yes. So I think at a high level, I see out of that 300 million, Maggie beer, we're targeting, 125 million. And part of that is e-commerce, or 25 million at least of that is e-commerce, because that's the aspiration for the Good Life range. And then the other 150 million is across Paris Creek Farms, which makes up a small portion. So the guidance we've provided for this year is 16 to 17 million in revenue. So the majority of that, let's say, 130 million is a combination of growth in Gifts Australia, Hamper Emporium, as well as the new verticals and new opportunities to fully utilise those assets, that we have in procurement, fulfilment, dispatch, warehousing. And over the 5 years, I'd see that the split of our business, will build towards a 60-40 e-commerce, bricks and mortar.
Okay. And then finally, I just want to talk about, reimagining. You're talking about, I guess, corporate gifting and B2B. I just, from experience, working for companies or having my own, that tends to be very seasonal, Christmas and, as we are seeing here today, coming into end of financial year where you're, doing stuff, whether it's for staff or major customers. Can you just talk about how, you can kind of maybe expand it out to be, something that company, you're kind of capturing a share of wallet throughout the year, whether it's company anniversary or, kind of, somebody's got 300 staff and, they're doing a Maggie beer for every kind of staff birthday. Is that kind of something you're trying to evolve in?
That's part of it. But you are absolutely right. At the moment, even corporate gifting skews towards Christmas. But there are some industries that have opportunities to gift, not their staff, but potentially their customers outside of Christmas. So as an example, real estate is an industry that has opportunities all throughout the year. Travel is an industry that has opportunity throughout the year. Corporate conferences, is another example. So, we're mapping the industries and currently can see opportunities for us to do things a bit differently to get into some of those other occasions and other industries that aren't so reliant on Christmas.
Yeah, perfect. Kinda, thank you very much. I think we're just coming up on time, and then I think rather than try and squeeze in another quick question and answer, we might just leave there. Thank you very much for joining us this morning. And if I could now ask you to just please stop sharing your presentation. Thank you. And I do know we have our next presenter patiently waiting in the wings, Bradley McCosker, the CEO of Australian Bond Exchange. Bradley, if you want to start sharing your presentation.
Thank you, Mark. Thanks, everyone.
Thanks, Kinda. Okay. Yeah, Bradley, I can see the cover slide of your presentation now. You can take it away whenever you're ready.
Yeah, hi, Mark. I assume I've got rid of my mute as well. So
you have, yeah, your audio sounds good.
Yeah, cool. Great. So yeah, I suppose thanks, Mark, for allowing me to be part of this. And well, welcome everyone to the Australian Bond Exchange presentation. I am, as Mike said, Bradley McCosker. I'm the Managing Director and CEO of the Australian Bond Exchange. As we are a financial services company, we always have to have our disclaimer at the start of every presentation. So sorry about that, guys. Now, today I'll talk a bit through the overview of the Australian Bond Exchange, who we are, where our business is currently, our achievements so far, and where our short-term priorities are for the business. Then I'll talk about the medium and longer-term strategic priorities, which we're very excited about due to the opportunities that they bring, not only to us, but also to our customers and other stakeholders. And then obviously there's a question for anyone to ask any questions they like about what we're doing and what we're up to. Now, a brief overview of who the Australian Bond Exchange is and what our purpose is and what we do to deliver on that purpose. The Australian Bond Exchange is a financial technology and services company. We use our proprietary technology to provide investors with access to the global financial markets. So that's regardless of portfolio size or the investor's sophistication. Everything we do is driven by our mission and our belief that absolutely everyone should have equal access to financial products. And our strategy to deliver on this core mission is to use our proprietary technology to remove all the barriers to entry that's traditionally been there, and it's limited investor access to the bond market, largely due to the transaction size and level of sophistication required. Now, we execute on that strategy today by offering investors attractive financial products and providing our clients with a user-friendly and efficient, transparent means to make financial product transactions. Though we're very much a fintech, we've got a very experienced board and executive team with years of experience. I won't go through them in detail. There's other presentations I'm sure you'll find, and you can find on our website. Suffice to say, there is years of experience in financial markets, bond trading, and IT. Our advisory board, which are an independent advisory board, are made up of people who are leaders in their field, and that includes fields of credit analysis, portfolio construction, artificial intelligence, which is gaining a lot of popularity lately, transaction process and settlement technology, which through distributed ledger is also gaining popularity, and global financial markets generally. I'm often told by other fintechs that and offshore investors that our team is a bit of an envy with regards to other startups. So I'm quite humbled that they've been willing to join me. Now, we're excited about the position we're in today. We enjoy a strong, sustainable competitive advantage in what we do. We've developed proprietary, innovative technology solution that offers market transparency and investor protection at the same time, which provides access to the over-the-counter bond market for all investors. Our business model is scalable in an industry with significant barriers to entry. This provides ABE with a clear runway to take advantage of the financial technology stack we've built. I'll take talk in more detail about some of the exciting developments in our technology a little later on in the presentation as part of the strategic priorities. The market opportunity is quite sizable. Global financial markets, I'm sure everyone understands, is massive. But for the broader investor base, it's been largely untapped, and we have access through numerous client acquisition channels to that market. And that opportunity is growing with an aging population, investing for retirement. Finally, the ABE team has the ability to tailor product according to investor preferences, which ensures that we're in complete alignment with the Australian investor. So we actually build the products and find the products and source the products for the investor rather than creating products and then distributing out to investors. So a bit of a different model than what you'd normally see. Now, I'll just give you an overview of the performance highlights so far for the 2023 financial year. Covers the first 9 months and our ASX reports so far. So our revenue grew to a bit over 4 million, which is up 96% year on year. Number of new clients has increased by approximately 59% compared to the same period last year. The average number of products held per client, which is an interesting metric, has increased by 24%. And the face value of our market-linked securities issues And those securities that we sourced specifically for the benefit of the Australian private client network, it surpassed $100 million mark during the year. The transaction volumes for that market has also increased by 65% year on year. So it's showing a solid year of growth for that foundation business. And finally, probably the most important for shareholders we have is we're extremely excited about the new payments platform and the CBDC pilots, which ABE is part of. And it's a really significant opportunity that will create in the medium to long term. I'll go into more depth about these shortly, but where this will go is unknown, but certainly there is a massive amount of opportunity there for anyone involved. Now, the FY 2023 numbers show that our revenue has grown significantly compared to last year. And while we're still not of a size that enables a very linear revenue path, we see that trend as increasing revenue is obviously positive for the business. This result has a large part being driven by our focus on client acquisition through multiple channels and investment in our sales and marketing teams. So that's had a negative operating cash flow result. That's reflective of the early stages of the growth of the company and the investment we needed to do in establishing those channels. So we're acutely focused on getting that cash flow levels to the sustainable and positive place that we need them to be, and we expect to be able to turn that into a positive cash flow within the next 18 months. So in order to become to a positive cash flow and profitable state the next 18 months, we'll continue to increase existing bond trading revenue streams, which includes securities trading revenue, the brokerage and origination and arranging fees. We'll grow the existing revenue stream by continuing to launch new products, grow client numbers and build marketing through an active sales and marketing strategy that targets new markets and leverage multiple distribution channels, like I said, including digital channels and financial planning networks. It's been a great source of opportunity for us. Now, while bond trading is the foundation of our business and the revenue streams are both, it's very stable and very sticky for us. The growth of these existing revenue streams and our scalable business model, it allows ABE to get to profitability, like I said, within the next 18 months. And of course, barring another pandemic or an equivalent catastrophe that gets thrown at us, we've got the scalability to basically gives us the opportunity to facilitate larger customer deals without increasing our cost base. So we've got the stable and sticky revenue that gets there. And now any incremental revenue should see an increase in margin as well. So we've kind of done the hard yards, and now it's time to see that take fruit. So we'll talk about the strategic priorities here. There's three major global themes that seems to be at the forefront of conversations today. So it's artificial intelligence, transaction technology, and ESG. There are many ways already are having a major impact on financial services in many other industries, I guess, too. ABE is active in all of these global trends, which will create significant opportunity for us over the short to medium term. And today I'll spend some time talking about them in more detail, about the first two trends anyway, AI and transaction technology, and what ABE is doing in those areas. Now, we've highlighted here just some key statistics on artificial intelligence just to illustrate the impact and opportunity brought about by AI, particularly for someone like us. A couple I'll call out here. Global AI market is expected to grow to 1.8 trillion by 2030. 77% of businesses are already using AI or exploring the use of AI. And this is no surprise, since given it's estimated that AI can increase business productivity by about 40% and improve data analytics by about 59%. And lastly, 41% of consumers believe that AI will improve their lives in some way, indicating that they're not averse to AI technology. And in fact, now the opposite is true, which is since we've been in operations, we've seen that shift in the mindset of just the individual and how they approach AI. Now, at the Australian Bond Exchange, we have been using AI for our credit analysis for a number of years now. All products we offer go through a rigorous due diligence process, and our artificial intelligence credit analysis is a key component of that process. Our AI credit analysis process produces a bond credit rating in a matter of seconds, where, to give you an idea, the traditional credit rating process can take up to 6 weeks or more. It's quite costly, and during, as we saw during a GFC, many companies with a strong credit ratings failed, and so it can be very wrong. Since we've been in operation, we've had global bond markets faced with many defaults. We've been quite successful. We have successfully navigated our way through them with the support of our AI credit default prediction models. For instance, in 2020, we saw the default of a local airline. I don't need to name who it was. Shortly before the default, the airline had credit ratings implying that they had less than a 2% chance that they would default over the next year. By comparison, for that same airline, our credit analysis that was underpinned by the AI algorithm, it was showing us something significantly different for the bonds. And because of that, they were screened out as part of our due diligence process, and therefore we never admitted that to trading status on ABE's platform. Now, we gave up a lot of business because of that. And sadly, for private investors that were invested in these bonds via alternative exchanges and through advisors in other networks, they experienced severe losses on something that our AI was predicting was most likely to happen. And that's just one example of where our AI credit analysis process helped predict and help protect our clients from poor investment outcomes, and know that it created from the basis of thousands of companies and millions of data points. Our AI process produces bond credit ratings with significant accuracy very quickly. It's by its very nature, it's independent. It's not human, so it can't be swayed by smooth talking CEOs. And it saves time, reduces costs, and because of this, we can make it accessible for everyone, which is part of our ethos as a company. And to give you some idea, the global credit ratings market is worth about 17.8 billion annually. That's quite a conservative estimate, and expected to grow by about to about 28.5 billion by 2032. So illustrating a significant opportunity there on something that we've been using internally. We're now looking at ways that how we can monetize that, since there's been a shift in people's perception on and being more comfortable with the use of AI in a number of different things. And we'll look at how we can use this outside of just our own internal due diligence processes, but expanding that out for use to the broader market. Now, like the AI slide, I've highlighted there's some key statistics with regards to transaction technology, including digital currency and blockchain technology, just to illustrate the impact and opportunity. Currently, there's 114 countries around the world just exploring and CBDC, I'm sorry, I should have introduced it, it's just central bank digital currency. These 114 countries represent about 90% of the global GDP. So it's pretty much who's who when it comes to countries. Now, the value of the blockchain industry is expected to reach 164 billion by 2029. Now, other stats that's worth highlighting around clearing and settlement, AustraClear, which is the settlement system for the fixed income market in Australia, settles around 100 billion worth of transactions every single day. And the other one, which is interesting with regards to clearing and settlement risk, is the amount of initial margin posted, say in 2021 for interest rate derivatives and CDSs alone was over like 323 billion. And that's just a small part of the market. It doesn't include equities, bonds, or FX transactions. So there's a lot of room to make the financial markets more efficient with the new technology that's out there. And we're on the right side of that. And now what we do as part of that, to understand what ABE is doing in this space, it's important to understand like what problem are we solving? Now, in many financial markets, there's significant barriers to entry for smaller investors. Many of these barriers to entry reflect just historic market norms. So what ABE is doing is breaking down those barriers and making it possible for the large number of smaller investors to access the markets that are traditionally the domain of a small number of large financial institutions. So we've rebuilt the transaction process entirely, making trading in over-the-counter transactions more affordable and more transparent, and therefore accessible to the average Australian investor or global investor for that matter. The result of this technology, I believe, is that middlemen in the transaction process who are there only because of legacy reasons just won't be necessary over the medium term. And these companies may still have a role to play. Don't get me wrong, though, if they add value to the investor, but unless they add value, they will be eliminated just through advances in technology. I think that's inevitable. So our transaction technology and settlement solution eliminates the need for traditional clearing. It's developed to cater for virtually instantaneous settlement, transaction settlement, and has transparent pricing. So it basically results in virtually instantaneous settlement, less cost, lower risk, and it's open to all, which is pretty simple to remember for everyone. I'll talk a little bit about digital currencies a bit more. The digital currency space, it's received a lot of attention over the past few years, and it takes a little while for nuances to filter out, including this slide. It looked like an add-on to me when I first started, but think of it as a sort of Venn diagram circles. And what we focused on is this bit, the central bank digital currency. That is something that, if you look at it, it's universally accessible, it's electronic currency, and it's central bank issued. So over time, I think we will see this space growing in popularity with respect to financial market transactions, and probably in the broader space as well. I think having something that is issued by a central bank and honoured by the governments around the world will be something that will be attractive to businesses to transact with, if they can get the technology stack right. I think that'll be something that will be a no-brainer. So our settlement technology solution is ready to process their instantaneous transaction settlement trades. It's been part of a successful pilot program to trial that instant settlement. These have included a pilot program and we partner with ANZ Bank to trial instant settlement using the new payments platform, which is part of the ISO 20022 protocol, which is a global banking protocol. And more recently, like I said, we've been part of a pilot program run by the RBA to trial instant corporate bond settlement using a digital currency on the RBA's distributed ledger platform. So it's been an interesting few months with regards to the RBA transactions. We issued a bond in the new digital currency, which is EAUD, as a trial. We did some transactions, which was instantaneous settlement, paid a coupon, and matured the bond, etc. So we did the entire thing just with the RBA and us, so we could test out the operational capabilities of the Reserve Bank's new currency and its new transaction platform. So there was a lot of learnings to be had there. I think the RBA will announce their findings sometime mid-year, which is the current estimate. So I'll leave that for them to share with the market when they're ready. So I've updated our shareholders previously on the good work of our team and the ANZ counterparts with respect to the new payments platforms. Now, in the MPP is Australia's implementation, like I said, of the global banking standard ISO 20022. That is currently being adopted around the world. I think the US went live with it about 3 weeks ago or so. And the benefits of this standard is numerous, but includes increased efficiency, enhanced client processes, automation of a whole bunch of functions, service innovation, frictionless cross-border payments, and the transaction messaging has significant richer data, which when combined with advances in AI, that it just gives an exceptional amount of possibilities to anyone involved. So for ABE currently, we see the efficiency gains in the elimination of errors in the transaction lifecycle, as well as the automation of multiple tasks. And as a result, both indirectly and directly, a better experience for not only our clients, but the other side of the transaction, so all stakeholders generally. The other pilot, like I mentioned, we've already undertaken as part of the RBA Central Bank Digital Currency Pilot Program. We did successfully do the real-time settlement of the bond transactions with the RBA. Now, part of that pilot, we were one of 15 successful use cases chosen to participate in this pilot program by the RBA. Now, CBDC pilots like this, they allow us to explore converting the bond into a smart contract that was traded on our proprietary system and settled using RBA's proprietary system, using the CBDC. The shift here by central banks is important, though. So not many people are seeing this, but throughout history, money itself and cash, I'm talking notes, coins, and etc., that's evolved in parallel with the technology available at the time. And however, like in the past 50 or so years, even longer, the focus has been on payments networks between banks, not necessarily between, with cash. Now, we've seen polymer notes and things like that. That's an example of technology in cash. But these CBDC pilots are a shift back to using existing technology to transform cash to better reflect the global move towards the digital economy. So usually you'll see advances in technology with regards to cash to reflect advances or reflect the economy at the time. And since we've moved to a digital economy, it makes sense to see cash move to digitization of some form. So that's where the global central banks around the world have started to look at this and say, we need to rethink what cash looks like, because the economy itself has changed right under our noses, and we didn't see it early enough, and now they're playing a bit of catch up now. So so I think these pilots around the globe, they signal a shift by central banks towards more of an open access to financial infrastructure. But in a way, they're looking at how they ensure safety for all participants, because obviously cash is cash still. So while there's many things to consider, millions of stakeholders in this when developing something, certainly the central banks have shown us that this is something that globally they believe is worth pursuing. Therefore, obviously, as a financial services firm, it's in our best interest to work with the governments to explore ways to benefit our clients and the broader financial markets more generally, and from that, our shareholders as well. So the key things I hope you guys take away from today's presentation is our core mission is to provide equal access to financial markets for all investors by leveraging our proprietary technology. I'm an Aussie. I just believe in a fair go. So having been in the financial markets for years around the world, I came back here and said, right, I'll give everyone a fair go in what I've traded in all my life. That's the ethos of the company. In the immediate future, our focus is to increase shareholder value by growing our existing revenue streams and continue to grow that through the active sales and marketing and product development that we currently do. Our systems and processes are right at the forefront of key global themes like the artificial intelligence and the instantaneous transaction settlement technology, which also helps break down the barriers for smaller investors to have access to markets they wouldn't otherwise have access to. And the longer term vision is for us to become the leading and most efficient market operator for pretty much any over-the-counter security globally. So thanks for your time, guys. If you have any questions, Mark, I'm happy to take them.
I just want to go back to one or two of the things in the presentation, Brad, if we could. You talked about the 24% increase in products held by clients. What's driving that? Is that getting more products onto the platform, so there's now like a wider choice, so people are taking it up, or is it a function of the steep increase in interest rates we've seen, and people are switching that asset allocation to maybe dialing back on risk assets and more into the defensive bond assets or credit assets, if we can say that, because the yield is there for them now where it hasn't been for, let's say, the last decade?
Actually, no, it's a little bit simpler than that. So what many people don't know about the bond market is, and it's kind of a byproduct of what happens on the news. When they talk about the bond market on the financial part of the news, they really are only referring to one type of bond, and that's government bonds, and usually about the 10-year or something like that. But bonds, there's different types of bonds. There's fixed rate bonds like those. There's floating rate bonds, which the return on those go up and down with regards to interest rates. So as interest rates go up, you get more coupon paid. And there's also inflation-linked bonds. So you can construct a bond portfolio that does well in any type of economic environment, right? So we're seeing at the moment that there's been a massive increase of inflation. That's been a problem for a lot of people. So at the moment, we're seeing rising inflation where inflation-linked bonds have done well and high yield bonds have done well. And obviously not so good for equities. Now, what you'll also see, and that what happens there is, is people will add to their bond portfolio. So when I talk about them being very sticky, it's more around finding opportunities to add to their portfolio with a different type of bond. So it's not necessarily to do with the interest rate, because the interest rate is just a relative thing, which is a little bit different from a product point of view to say equities or real estate, which, obviously your dividend income is is fighting for income stream compared to say government bonds or term deposits or things like that, where with the bond market, you can really construct a portfolio with your clients. So it doesn't matter what happens, inflation goes up or economic growth goes up or down, doesn't really matter, because you can have a portfolio with them that does well in any type of environment on its whole, right? So what we're seeing is the increase in products is they're slowly shifting out of the other asset classes and moving more and more of their assets into their bond portfolios, which is great for us. So it's not necessarily to do with the interest rates themselves. We find that once we get a customer, it's more like an annuity stream. Our retention rate is very high, over 99%. We keep our clients. They continue to add to their portfolios. They don't necessarily trade them. They'll hold them to maturity and then buy new ones as they mature off, but also as other assets are monetized, then they'll, instead of buying more equities or whatnot, we see this trend of they buy more bonds as opposed to the other assets in their portfolio.
And talking about customers, in terms that you were talking about, trying to get a more of a push to get even more customers onto the platform, is that trying to get a deeper penetration into the dealer groups and the private client markets, or is it trying to get your more pure retail SMSF style investor on there who's let's say got between 5 and 50 grand to allocate out as part of their kind of wider portfolio? Like who are you targeting in that sales and marketing push in terms of customer groups?
Yeah, so we do all of the above. So we have different funnels for different type of customer. With the ethos of access for all, we took the view that we should make it available for absolutely everyone, and different customer types require different marketing strategies, and we do use different strategies for each one. We've certainly seen probably the most obvious shift has been the financial planners, who in the last, I would say, 6 months have really turned to us for help on constructing bond portfolios. And for us, rather than having a bond ETF or a bond fund, they're looking for direct bond investment. The difference there is like an equity itself, like a share, is basically it's a perpetual instrument. It doesn't have a maturity date, where bonds do. There's every bond we have, they actually have a maturity date. So if there's an equity ETF, you have something without a maturity date, they buy an ETF on it, it has no maturity date. So the underlying feature of that product doesn't really change, where with a bond fund, you're turning bonds which do have a maturity date, and you're buying a bond fund. Yes, theoretically it replicates the exposure to fixed income, but when you look at it, you don't get that buy to hold, get the maturity back feature when you move from a direct investment in bond and buy a bond fund instead. And we're seeing a lot of financial planners realize that, particularly now that interest rates are moving up. So a lot of the bond funds are not being able to get their tenor right with regards to their maturity profile. And now I think that's coming under roost a little bit, and the financial planners have looked to us to sort of advise them for their clients on what would a direct portfolio look like, and it does infinitely better if you construct it well compared to just being in a bond fund for their clients. So that's what we're seeing. It's the feedback we've been getting.
And then on the origination side, are you know, as we said, you know, the interest rates have kind of moved a lot. You know, what's happening there in terms of, you know, the issuers, be they, you know, on the corporate side or the state side, in terms of, you know, we're doing an issue or a refresh of our, you know, kind of debt structures as happens as, you know, that maturity profile comes on. Are they now looking to, you know, come onto the platform, whereas maybe 2 years ago that wasn't the case? They were just going through the historic distribution channels.
Yeah, so we also participate in the global bond market itself, right? So we do institutional business. That's very attractive for us for a number of ways. So we are part of that. What I'm seeing in that market itself actually is that they are coming back to the market more so. There was a lot of effectively free money during the QE programs because of COVID and things like that. Now that's tightening up. There was a bit of a lull, and now I would say in the last 3 to 4 months, we're seeing a lot more activity in that market. What I'd say, there's probably a broader theme where the banks aren't necessarily the liquidity providers they used to be in that space. So what they call the buy side, so the fund managers are seeking out, you know, firms like us. Most of my staff and myself have global financial markets experience. I've worked on Wall Street myself, and I know most of the market around the world. It is quite a small market in number of people. We all know each other despite all living around the world in different spots. And we've all ended up outside of banks somewhere in funds or hedge funds or super funds or things like that. And there's more and more where they're starting to find each other and deal directly with each other rather than through the traditional liquidity providers of banks. Now, there's a number of reasons for that. Part of it's regulatory, part of it's balance sheet. And I'm seeing there's more of a shift that way rather than just on to be said, there's a new bond being issued every single day we've seen this year. So, to give your listeners some context, the bond market dwarfs the share market by a factor of like 10 to 1. So the numbers just don't even compute compared to what you'd see on the ASX. The global bond market's massive. So there's always a bond out there. There's always a new one. There's always a bond maturing, and there's over 1 million bonds we scan every day for our clients to find the best ones that show the best, basically, risk versus return capability for them. So we're quite active right across from the largest insto to the smallest client.
Perfect. Bradley, we're gone slightly over time, and I do want to respect your time and indeed the people on the call. So thank you very much for joining us this morning, and hopefully we can have you back on maybe later in 2023 to give us an update, and hopefully the RBA will have published their trial results by that point, and maybe we can go into that in a bit more detail.
Yeah, it'd be interesting what they come out with. So thanks, Mark. Thanks for having me. I love your podcast. So they're great.
Okay, great. Thanks, Bradley, and thanks everyone for joining. And with that, I'll close this morning's meeting and wish everybody a good rest of their Thursday. Thank you.